In this video, guys, we're going to look at the bull versus bear thesis for the current coronavirus impact on the markets. Stay tuned. Hey guys, a very warm welcome to you. Thank you for joining me. Alright, so what's the bull thesis versus the bear thesis? We hear all these arguments, and to be honest, they're both very, very valid. And as a trader who's looking for a longer term move, if you're a day trader, it almost doesn't matter. You're trading the day-to-day swings, the price action, you're kind of immune from all this. But if you're a swing trader, again, and maybe you can kind of inoculate yourself a little bit by trading a couple of day swings and just using price action for that. But let's say you're investing a little bit longer term. Let's say your swing trading positions are much longer, then you're probably trying to come up with a thesis. Are we going to head much lower? Are we going to head much higher? So some of the things I've heard for reasons for the bull thesis versus the bear thesis. Add yours in the comment section below as always, guys. And at the end of this, what we can do is we can see which one maybe has more weighting, or you can consider which one has more weighting here, just to kind of highlight some of the ideas and maybe get a feeling about where the market is. So at the moment, we are really in the thick of this coronavirus stuff. The markets have been limit down, actually went limit up today, and now they're almost back to break even. The volatility is huge, but there is still a lot of pressure on the markets. Of course, the bulls come out and they say, hey, listen, this is a great time to buy. Historically, dips are a great time to buy, and that is true. Right, historically, if you look back, when you buy a dip, it's a great time to buy as long as you can sit out any more pain. And the problem you have, just kind of playing devil's advocate for a moment, is if your timing is out, then you have to sit through an awful lot of pain. You know, there's very many people who are calling to buy the dip last week, and that was way too early. And so who's to say this is too early now? This is the trouble. But if you can ride it out for a super long term, then everything in history now, who knows what whether it repeat itself. If we're going to a depression, then could be completely different. But you know, historically, we know if you look at the chart, buying dips has worked. So that's the big bull kind of thing that they tend to shout about. The main thing is they say it's a blow over. A virus will blow over. It's not going to last. Once it's done and it's infected people, unfortunately, people are going to die. Unfortunately, people are going to be infected. However, it will pass, and when it passes, then we could be back to normal. The death rate is low, something that they're saying that the virus is, you know, it's not a virus that's impacting and killing kind of 20% of people it infects. It's relatively low. It's not really affecting much of the population. And this is kind of some of the reasons they're saying, hey, well, you know, even if it does spread through, yes, it's going to be unfortunate, but we're not going to be wiping out many people. I can't believe I'm doing a video about this. I mean, we're crazy times, isn't it, guys? Anyway, third one is people will still spend. So there is an argument that, okay, if let's assume from the bull thesis and kind of put the bull hat on for now, that they're still in work, they're working from home, they're just not out and about spending on other things like travel, like holidays, like eating out, like leisure, like those things that are probably going to be impacted, they will still spend. And people are suggesting, well, people aren't very good at saving, they're going to be spending it anyway, they're going to spend it on Amazon, maybe they're going to spend it on a car, maybe they're going to be spending it in other areas, and so the economy is still going to struggle, but still going to struggle for a bit, but actually it will improve because we're just going to shift the way that people spend during that period of time. That's one of the arguments. Whether you agree with it or not, let me know. Next one is it's hyped up. People say the virus is all hyped up. It's completely overblown and it's not as bad as it sounds. Who knows? The news flow is so varied. It's difficult to know what's true out there, isn't it, guys? Right. The economy will recover quickly. So even if you do think things are going to get impacted, and they definitely are, they are at the moment. We can see literally people saying the numbers of people inquiring for holidays, the footfall in some of the shopping malls, all this kind of stuff is already down. So profits are already going to be down. So the bulls can't really use the argument that it's not going to have any impact, because it is having an impact at the moment. But their argument is, hey, the economy will recover quickly. It will pass through. The virus will pass through. Yes, some companies are going to be struggling, but everyone will come out the other side. There's plenty of liquidity. There's plenty of debt that they can use. There's plenty of money around. The governments are taking action to provide and help businesses and all this kind of stuff. So they think the economy will recover quickly, so it might be a good opportunity to buy for a recovery. The thing is, many stocks will do well. And the bull argument is, hey, listen, yes, cruise liners, airlines, hotels, casinos will be hit, and they may well struggle, but there are going to be very many stocks that will do well. And the broad index might well be made up of the reasonable number of stocks that actually means that hey, some of those are going to perform really, really well, and that might undo all the bad stuff. And also the other thesis is that, hey, if you select the right stocks, you're going to do better. Well, we know that anyway, but their thesis is if you stick to the stocks that aren't as impacted, it's a good time to buy. The other thing is, a bull thesis is people are panic selling. People are just liquidating for whatever reason, and that's causing this drive lower. Now, you know, when people are selling aggressively, what happens is if there's no liquidity to soak them up, we get more of an extended move. So the bull thesis is, hey, we're well extended because there are no buyers out there, or very few buyers, and a lot of people wanting to get out of the door. Now, that may well be true, but does that mean that it doesn't continue? Again, who knows? That's something for you to think about, but it's reasonably valid. So we'll put valid arguments here. Right, let's look at the bear thesis. So Bear Thesis says, hey, the virus is just getting started. We are just seeing the very tip of the iceberg. It's about to rip through the population of multiple countries. We're starting to see countries locked down. We're going to see, you know, bigger countries, bigger economies locked down, no business being done, no travel, no people spending money, companies going bust. It is just getting started. Second one is you can't trust the China data. So this is kind of a response to maybe the bulls that say, hey, China data at the moment says that the virus curve is flattening out in terms of infection rates, and the new infections per day is slowing down. So they've found a virus peak, in which case that's, you know, they're saying, well, that's bullish because ultimately we can see an end in sight. There's kind of light at the end of the tunnel. The bears are saying you can't trust the Chinese data. You don't know if it's true or not. So we are going to find out for ourselves, and it may well be heavy. Another thing is the economic impact will be huge. So it kind of ties in with the first one, really, doesn't it? That there are companies that will not survive, big companies that won't survive because they can't find the liquidity, they can't borrow the money, they can't weather the storm, they have huge kind of monthly payments to make. And if they suddenly don't make money for 3 months, that's enough to send many of them under. And that can cause a knock-on effect to multiple different things. There, people lose their jobs, they then don't spend, that business doesn't make the money from their spending. You know how the whole thing works, guys. You know, the impact will be potentially huge. Many companies cannot survive. So touch on this a moment. You know, some of the companies literally need that month-to-month profit just to keep going. And if they don't have that, they haven't got enough money in reserve to kind of weather this storm. Another thing is banks may stop lending, causing collapse. So one of the bear theses is that, hey, the banks just haven't got the money to lend or aren't willing to lend, or maybe there's a liquidity crisis between them. I don't think we've seen that yet, but that's just sort of the bear thesis. Even the government is stepping in and providing liquidity. If the banks aren't lending money to businesses to help them through this, then the bear thesis is, hey, that's going to cause significant impact and damage. Another thing is we're headed for a crash anyway. This was just the thing that started the ball rolling. Bear argument is, hey, whole thing was overvalued. Market was ridiculously high, overvalued, and we were just waiting for the catalyst. This is the catalyst. It happens to be quite a damaging catalyst as well, but actually the true valuation for the stock market should be X% higher. And if you add the damage from this, we should be much, much lower. Bear argument. Final thing, markets historically fell much more. They go back and they look at a chart and they say, hey, look at all the times that we had huge impact on the market, whatever times they may be, going back to like stock market crashes, going back to Great Depressions, going back to credit crunches, all this kind of thing, global financial crisis, all these things that are dotted around that you can see on the chart. And their argument is, hey, from peak to trough, the percentage move is generally quite large, and we haven't really got anywhere near that yet. So that's the bull argument, that's the bear argument. Oh, what do you think, guys? Do you think it's going to be higher in 6 months' time, or do you think it's going to be lower in 6 months' time? Do you think it's going to blow over, or do you think the damage is going to be so great that we're going to struggle to claw our way back over a longer period of time? Let me know your thoughts in the comment section below. Interested to hear what you guys got to say. Take care. Bye-bye.